Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to Edupediaworld.com, your online gateway to the world of invaluable knowledge. Let's continue our discussion from where we left last. During our last discussion, we started to talk about the time value of money. We tried to understand what exactly time value of money means, what is the essence of the study of time value of money. We tried to understand that why exactly time value of money plays such an important role in making those cash flows comparable against each other which have been segregated by a time gap. We try to understand that there are certain cash flows which take place at T0 or at the present time, and those cash flows may be cash inflows as well as cash outflows, whereas their potential benefits or their outflow in terms of repayment of their interest on the capital or dividends, they might take place at a distant future, which we are denoting by the Tn. But as we have already discussed, that finance managers, they cannot sit idle just for the sake that since the cash flows are differentiated by time, their differences, they should not simply sit idle and do not take any decisions. Rather, they have to take decisions because businesses are being run on the going concern basis, and for taking sound decisions, it becomes very important for the finance managers to make the cash flows comparable against each other, and for which the time value of money plays a very important role. Much about that we shall be discussing shortly. Then we try to understand that why exactly the cornerstone theory or time value of money, that is the money at our disposal today, is important, much more important than what we shall be getting in the future. So we have tried to understand that the current money can help us into transaction, into our consumption, into our investment, into speculation, while if we are parting away from our money, we are devoid of all these benefits. So, and we have also discussed that the current money which is with us at our disposal, it is quite risk-free in terms of your default. But again, we also discussed that if at all an investor needs to part away with his or her money for a distant future, in that case he or she does it only when he or she is being offered with a compensation against the foregoing. So this compensation is basically what? This compensation is basically nothing, but it is the compensation which the investors rightfully demand for the benefits or for the comforts which he or she shall be sacrificing for not keeping the money with himself right now, rather than investing it for a distant future. So such a compensation is also technically known as the required rate of return from investors' point of view. So we tried to finish off our last discussion on a note that time value of money discussions are important not only from a corporate finance point of view, but also from an individual investment decisions making point of view as well. Then we tried to discuss that what were the two major components of the required rate of return. So we discussed that the two major components of the required rate of return happens to be the risk-free rate of return and a risk premium. So regarding risk-free rate of return, we tried to understand that risk-free rate of return refers to those return which an investor enjoys without practically taking any risk against default or repayment of a principal or the interest thereupon, etc. We try to back our rationale with an example of investment into gilt-edge securities, government securities, bank FDs, etc., etc. But then the more important part happens to be the second part, that is the risk premium. As you can see on your screen that there is a formula written over here, that the equation for the required rate of return looks as under: RS is equal to RF plus RP, whereas RS stands for the required rate of return from an investor's point of view, from corporation's point of view, and RF stands for your risk-free rate of return, while RP represents your risk premium. So the entire risk RS, or the required rate of return for an individual or for a corporation, is a function of two parts. That is, first one should be your risk-free rate of return and the risk premium. Now the question arises, dear student, that what exactly is this risk premium? Why do we need a premium against a risk? So one thing we should try to understand very clearly, that the moment we are parting away from our cash, the moment we are parting away from our cash for a future period, so we are being fought, or we are being surrounded with a number of risks. So risk-free rate of return is not only one potential return which we should be looking forward to. Rather, we should also try to compensate ourselves against those inherent risks which come or which take place the moment we are parting away from our cash. Now, so the required rate of return can also be termed as an opportunity cost of capital as well. Much about that later on, but right now, as I said, that the required rate of return is important not only for the individuals but also for the corporations. For individuals, it is known as a required rate of return. For corporations, it is technically known as the opportunity cost of capital. Now, the required rate of return is a bare minimum return which the investors shall be requiring for parting away from their money. This has already been discussed, that rightfully said that the required rate of return is a bare minimum. It should be the bare minimum return against which the investor should choose to part away with her money at all if he or she really needs to do it. If he is not being guaranteed the bare minimum required rate of return, then I think he or she shall not be interested in parting away with the money and in the process foregoing the current benefits which they shall be enjoying if they are keeping the cash along with themselves. So, again, the risk-free rate of return is a return which the investor shall be enjoying without taking any risk. Without taking any risk in terms of what? Without taking any risk in terms of the risk of default, the risk of a guarantee against the payment of your interest and the repayment of the principal, etc. Such risks are almost assured and insulated against any risk of loss of principal and the interest. Now, risk premium represents the extra return demanded by the investor up and above the risk-free rate of return. Again, revisiting the last formula, it was RS is equal to RF plus RP. So, if you can take a closer look as a formula, you will find that the RP or the risk premium is being asked in addition to the risk-free rate of return. It means that once when the investor is satisfied that his or her risk-free rate of return has been guaranteed, then he or she puts a claim against the risk premium which she shall be taking. Thus, this so-called extra premium or extra return for risk depends directly upon the riskiness of the investment option and the time for which she is asked to part away from her wealth. Now, this is a very important point, my dear students, that what determines the risk premium? What is the logic? What is the rationale behind asking for a risk premium? So, as we said, that the moment we are parting away from our cash, the moment the cash is moving away from us towards any other unforeseeable avenue or investment avenue, obviously we get surmounted, we get fraught with a number of risks. So the investors always ask for a compensation against those risks, and those compensation are always up and above the risk-free rate of return which he has been guaranteed. So the longer the time, the more profound the various risks become, hence higher goes the risk premium. It goes without saying. The time value of money concept also says that the longer we are parting away from the money, the longer the money is away from us, the higher the riskiness which comes into the picture of that money not coming back to us. Once again, I just repeat myself. Time value of money also says that the longer the time frame for which the money has walked away from us, the more profound or more pronounced the risk of the same money not coming back to us becomes very glaring. So, longer the time frame, the more and more various kind of risks they come and they surround our cash which we have lent out or which we have invested into a particular avenue. So, and this risk premium, once again, student, this is not to be taken into isolation, but this particular risk premium has to be demanded, or rather it is being demanded by the investors and the corporations alike, in addition to the existing risk-free rate of return which he or she has already asked for. Now, what are the other risks apart from the risk-free rate? What are the other kind of risks against which the investor should ask for a risk premium? I once again repeat my question, dear students, that what are the other kind of the risks against which the investor asks for a risk premium which is up and above the risk-free rate of return? Okay, for risk-free rate of return, we are sure that they are being guaranteed, they are being somewhat assured that there won't be any loss of capital, there won't be any loss of principal, there shall be timely repayment of the interest, there shall be timely repayment of the principal, etc., etc. It is being guaranteed by the bank, it has been guaranteed by the governments who are having a peculiar power, and who is having a very strong power of printing more and more notes if at all a case of default looms large over them. But unfortunately, the power of printing the notes, the power of printing currency lies only in the hand of the governments, and unfortunately other corporations or other avenues of investments, they lack this kind of an power of printing notes and making good the default at all if it takes place. So in this particular case, it becomes very pertinent that certain other risks which are apart from, which are up and above the risk-free rate of return should be discussed, and it should be understood clearly, because based upon their understanding, the risk premium is being demanded by the investors as well as the corporations. Now, some of the prominent risks which loom large apart from the risk-free rate are the business risk, the default risk, the operational risk, financial risk, market risks, liquidity risks, and technological risks, etc. I once again repeat, some of the prominent risks which we can think of in the modern day times are business risk, their default risk, operational risk, financial risk, market risk, liquidity risk, technological risk, and I should also like to add a new kind of risk known as the geopolitical risks as well. So these are some of the risks regarding which we can think of, regarding which we should try to put our guard against, and such kind of risk should be covered along with a higher risk premium. It means the more or the longer the time duration for which we are parting away from our cash, more pronounced all these risks become on our investment, and so we require, or the investments or the corporations or the investors or the corporations require a higher return in the terms of the risk premium in order to cover for all these aforementioned risks, and this should be asked in addition to the existing risk-free rate of return. Now let's discuss each and every risk in a nutshell in a very brief fashion. So business risk. So how do we define the word business risk? So business risks are those risks which are concerned with the changing business scenario of a particular country. No matter how many strategies or how foolproof strategies a firm is making, suddenly there might be certain systematic risk, there might be certain risks, certain uncertainties, there are certain unpredictable conditions which go beyond the control of the management, which have been taken by the industry, which has been taken by the government, and which has got its bearing on the entire industry to which a particular business is a part of. So secondly, there can be a new entrant in the market, there can be a new disruption in the market, there can be a new competitor who is armed with a newer technology, who is armed with a new strategy. So this kind of businesses, they always loom around while doing a particular business. So default risk, obviously, as I said, that banks, financial institutions, and the governments who are being backed by certain powers, who are being backed by certain privileges, it is okay for them. But most of the cases, there are many such private borrowers who are not so privileged enough to take care of their investors' returns in case of a default. In this particular case, if a company is going bankrupt, the investors have got a little option rather than to lose their money. So operational risk, obviously, there's in our day-to-day operation activity, we have already seen in our last discussions that operating activities play a very crucial role in the well-beingness of a company, but it is much easier said than done. Might be possible that the real life, a lot of operational hazards, a lot of operational risks might come to the fore, which can disrupt the business operations and which can create a severe impediment to the future course of the action. Financial risks, obviously financial risks are always there. Suppose a firm is very high on the leverage, a particular firm has taken a lot of borrowings on the market. In this particular condition, the equity investors, they are quite circumvent, they are quite skeptical regarding the bankruptcy, regarding their own returns after the compulsory payment of the interest part. We all know the payment of an interest is always a charge against profit. It means no matter the profit is there or not, the interest commitments have to be met. There are certain market risks. It means that might be possible that a proper marketability of the product or the proper marketability or the financial securities are not taking place in the same node. Particular securities are being illiquid in the market. So investors might just get into a risk of losing their money for holding on to such securities which suddenly become illiquid in the market, which they cannot offload in the market, which they cannot sell off in the secondary market, so thereby inflicting a lot of damages to them if these risks turn out to be really bad. Technological risk, we all know we are living in a world wherein technology plays a very, very crucial role. Everything is being touched by technology. Robotics is coming up, artificial intelligence is coming up. So technology is a boon as well as a bane both for us. It is a truth that technology helps in a better and efficient management, in better operations, better product quality, but at the same time, heavy reliance on the technology might also create a damage if there is some technological disruptions, certain technological disturbances, some malwares are coming down, some hackings are taking place. So this technological risks are always looming large on a business. Suppose a particular operation which is relying heavily on technology, but due to some reason or the other, that particular technology crashes down, so the entire operations get badly affected for the entire day long or for the days to come, for months to come, and this seriously impedes the daily operations or the revenue earning capacity of the firm as well. Now, geopolitical risk, with every passing day we are seeing that nations are bidding against each other. They are not in a very good terms. Some countries are fighting over oil, some countries are fighting over some armaments. There's a lot of protectionism taking place, embargoes are taking place. So these are some of the risks which come inherent with any business decisions with which the individuals and the corporations, they have to live on. But the only way of avoiding these risks are two. Number one, the best way of avoiding these risks is not to get into all this risk at all, which is a very remote possibility, because being into the investment world, being into the world of your business, you have to take certain your decisions, no matter how risky they are. The best thing that can be done is that they should be hedged against, they should be controlled, but they cannot be eliminated fully. So investors demand a premium to cover all the aforementioned risks in case they are willing to migrate far away from the risk-free rate of return. Obviously, if the investors or the corporations are trying to stay closer to the risk-free rate of return, or if they find that a particular investment opportunity or a particular business opportunity has a more toned down or has a more moderate exposure to all these risks, then the investors shall be enjoying the liberty of tweaking or changing the risk premium in addition to the risk-free rate of return as per their own perception against the risk. One thing, student, I would like to make very clear that risk is more of a relative term. Something which might seem risky to one person might not seem too very risky to the second other person. Secondly, there are certain people who have got an aversion towards risk, while there are certain people who are quite attracted towards taking the risks. But again, how much a risk premium an investor or corporation shall be asking up and above the risk-free rate of return depends totally upon his or her perception regarding the various risks. But as a general theory, as a general practice, we safely assume that investors and people are generally averse towards risk. They do not love to get into too much of a risk. They always try to take some calculated risk, and they are not very reckless with that. And so if they find that a particular business proposition is entailing too much of a risk, or it is the business investment option is fraught with a lot of risk, so they choose either of the way. First way is that they either steer away from that, they either keep themselves away from such a risky proposition, or number two, if at all they are attracted towards it, if at all they have to put their money into that, so they ask for a very higher risk premium in addition to the RF, which invariably increases the overall RS, or the required rate of return from the security. So thus we say that whatever required rate of return from a security is being asked, or in a simple terms, whatever compensation is being asked for parting away from the money from the safer zone, from the today's zone, towards a more uncertain or a far away zone in the future, it takes place only when the investors are assured a return in terms of the required rate of return from a security, or the RS, which will be a combination of the risk-free rate of return as well as the risk premium. Again, the risk premium will be depending heavily upon the kind of the risks which have surrounded the particular business decision. So a simple rule says that higher the riskiness of the project or the investment decisions, higher will be the asking rate regarding the risk premium. Lower the riskiness of a particular proposition, lower will be the risk premium which shall be asked by the investors. So a higher business decision, or a higher investment decision, or a higher risky business decision, or a higher risky investment decisions always calls for a higher RS, while a lower risky or a less riskier business decision or a business proposition asks for a lesser or a more moderate or a more benign or a toned down required rate of return on the security. But one thing is sure, irrespective of the nature and the tone of the riskiness, the risk-free rate of return is a bare minimum rate which investors shall be asking in any case, whether the riskiness is high, low or moderate, and up and above it will be the risk premium which shall be decided firmly upon the fact that how risky a particular proposition is. Higher the risk, higher will be the RP, lower the risk, lower will be the RP, with the RF being constant. Now a simple example shall make the concept even more simple, even more easier to understand. Now suppose Mr. X has the option of depositing 10,000 USD in a fixed deposit with a local bank for 3 years, which promises an interest payment of 10% per annum for 3 years and the repayment of capital at the end of the 3rd year. Since this is an investment into a bank FD, it entails almost nil risk of default in terms of annual interest payment, that is 10% of 10,000, that is 1,000 per year. So a closer look at the question shall reveal that it is a simple case in which Mr. X, right now he has got an option of depositing his 10,000 USD into a fixed deposit with a local bank for a 3 years time frame, which has assured him an absolutely risk-free return of 10% per annum in the form of the interest payment. It means that if Mr. X is serious about depositing 10,000 USD for 3 years at 10% with the local bank in its FD, it means that Mr. X will be very much sure that there are hardly any risks in terms of the default in the repayment of the interest and the repayment of the principal at the end of the 3rd year concerning with the payment of the money into the bank. So if he deposits 10,000 into a bank for 3 years, fetching him a return of 10% per annum, Mr. X should be more than happy to avail this particular opportunity for taking almost zero risk or nil risk in terms of putting his money into an FD or investing his money into an FD. So he is very sure that for 3 years he shall be getting his interest income at a rate of 10% for 10,000, that is $1,000 per year, and at the end of the 3rd year he shall be receiving his $10,000 back, which he is depositing today. Now, in the second case, suppose the second option comes up. In second case, Mr. X decides upon starting a business for which he shall be requiring $10,000. In the first case, Mr. X was having an option of putting his money into a bank FD with a local bank, while in the second case, he is being provided with an option of starting a business for which he shall be requiring $10,000. Now, one thing becomes very explicit, one thing becomes very clear, that so long Mr. X is staying put with the bank FD, so long Mr. X is happy with his bank FD, he is not taking any risk, he is very much sure that for the next 3 years he shall be receiving his 1,000 USD per year as an interest payment, and at the end of the 3rd year, along with the $1,000, he shall be getting back his 10,000 USD as well. So he is almost having a very peaceful life. He is under no stress, he is under no duress whatsoever in terms of an uncertainty of risk or anything. He is absolutely free, and his risk-free rate of return is 10%. But the moment Mr. X decides to start a business of his own for which he shall be requiring 10,000 USD, so it becomes very clear the moment he is contemplating about starting his own business, it means Mr. X will have to move away from his safe zone to a more vulnerable zone. He has to move from his comfort zone. What is the comfort zone in the case of Mr. X? The comfort zone in the case of Mr. X happens to be the bank deposit. While if he is willing to take his plunge into the world of business, it means what? From his safe zone, he has to move into a zone that is the world of business, which is full of a lot of risks and uncertainty. Of some of the risks which we discussed in just a few moments back, all these risks are absent when he is living a peaceful life with a bank FD and he is happy with the return and he is happy with the repayment of his interest and principal. He is least bothered. But the moment he chooses to venture out from his comfort zone and step out from his comfort zone and venture into a uncertain world of business, it means what? He shall be surrounded, he shall be forced to look into the eyes of the various kind of risk which come inherently with a business decision. So now he is having two choices. Mr. X is having two choices. Either Mr. X chooses not to embark on his own business, he chooses not to start his own business and live his life simply with the bank FD, and second, he becomes a bit adventurous, he becomes a bit venturesome, and in order to earn a higher degree of profit, in order to earn a higher return, he decides to take a plunge in the world of the business. The moment Mr. X decides to take a plunge in the world of the business, the moment he decides to take his 10,000 USD out from the bank, he shall be losing the opportunity of getting the return of 10%, assured return of 10% per annum for the next 3 years. So the opportunity which he is losing by not keeping his money with the bank should have to be repaid by the business at the very first place. So once again, students, if Mr. X wishes to move out of his safe zone and then park his money and rather take his money out from the bank and then invest the money into the business, then the first and foremost return which the business should compensate him, or the first and foremost opportunity cost of capital, shall be risk rate of return of 10%, which the business will have to return to Mr. X, because it is the opportunity which Mr. X is losing. If Mr. X is availing the opportunity of starting his own business, then he is foregoing an existing opportunity of earning 10% risk free from his bank, and that opportunity has to be compensated by the business, and this particular phenomenon is technically known as the compensation for the opportunity cost of capital. Opportunity cost of capital means what? That it is the cost which has to be returned by the business to Mr. X for the sake of Mr. X's forgoing one opportunity for the sake of another. So whatever cost Mr. X is forgoing by not staying put into an existing opportunity, not availing an existing opportunity, and then putting his money into a second alternative or a second opportunity, the second opportunity will have to compensate this loss of opportunity to Mr. X. Now this was the first part. This was the compensation for the risk-free rate of return, that was a 10%. But as I have just discussed, the moment Mr. X decides to start his own business, the moment Mr. X starts to venture into his own business, he shall be surrounded by a number of risks like his liquidity risk, his market risk, his technology risk, his business risk, geopolitical risk, etc., etc. So the moment he is moving from a certain zone to an uncertain zone, he shall be fraught with all this risk, and then it will again become the duty of his business, or rightfully it will be a claim put by Mr. X on his business to repay him for these unforeseen risks at the same time. That should be in addition to the existing RF or the loss of opportunity cost which the business has to repay to Mr. X. In simple terms, it means that the moment Mr. X decides to take his money out of the bank and then invest into his business, then the business will have to generate a return or the RS to Mr. X in the form of the 10%, that is the loss of opportunity. In addition to it, a higher risk premium if Mr. X finds that the business opportunity contains the particular business opportunity is exposed to a higher degree of the various kind of risks which we just discussed. So if a business is having a higher degree of riskiness, if the business is having a probability of being more unsure or being more uncertain in the future, then rightfully Mr. X shall be asking for a higher risk premium from the business in addition to the loss of opportunity that is in the form of the risk-free rate of return, the 10%. In addition to the 10%, Mr. X shall be rightfully asking for a higher risk premium from the business, and the RS will have to be borne by the business in terms of the cost of capital towards Mr. X. So if Mr. X finds that a business opportunity is entailing a higher degree of the risk, then rightfully he shall be asking not only for the return of his risk-free rate of return, but in addition to it, the premium shall be higher for a higher degree of risk. And if Mr. X finds otherwise, that no, the business opportunity is not surrounded by a very high higher intensity of risk, then he shall be toning down, or he shall be lowering his expectation in terms of the return, in terms of the risk premium rate of return. So if there is a higher riskiness, then the total RS will be the existing RF of 10% plus the risk premium which Mr. X estimates regarding the business. And if the business is having a lower riskiness, then again the RS will be the 10% required rate of return, and in addition to it, there should be a lower risk premium based upon the estimation of Mr. X. That's all for now, students. In the next discussions, we shall be talking about how exactly to calculate this risk premium, how to put a more pragmatic approach towards assessing the various risks which need to be covered by the risk premium. Thank you, students.